This week, I thought we'd spend a minute just speaking about one of the most powerful formulas in investing and maybe even in life. And that's the one about happiness. It goes something like happiness equals reality over expectations. And this week in the investing world, we get to have a look at the reality of what people have been expecting for some time, which is the first interest rate cut from the US Fed. Now, this has been a long time coming. As many know, interest rates were raised dramatically in the post-pandemic time to fight inflation. And now inflation has come down in many places around the world. In fact, just this morning, Canada released their consumer price index data, and they're back to 2% year over year on that measure. So the US is not quite that low yet, but near enough that expectations are the Fed can begin cutting interest rates. And lower interest rates, good for the economy, good for financial assets, all things being equal, investors prefer lower interest rates. The question, though, is, and this is where the reality hits in the formula of reality over expectations, we expect there's going to be a cut in rates, but we also are expecting in the markets right now that the economy is not really going to weaken that much as these interest rate cuts happen. In fact, the expectations for rate cuts have the Fed, with interest rates now at 5.25%, dropping them to 3% by the end of 2025. So that's a pretty steady pace of cuts. But at the same time, markets are kind of expecting that corporate earnings will keep being fine, the economy will keep being fine. And I'd suggest we're going to get a real glimpse this week into what the fears and hopes might be. First reaction might be quite positive after the Fed cuts, but then we'll see what the real reality is. And I suspect investors in the next month or two are going to be grappling with two major things in the US, one, the election, and the other, what exactly is going to be the sort of the background against which the Fed is cutting interest rates, if they do cut them as fast as the market's currently expecting. So we'll see some reality this week on interest rates. In terms of the Fortress funds, a little bit of a positive week last week, and we've been chipping away at some areas of the market that are interesting to us, some things that have come off recently in Japan we've been chipping away at, a little bit in emerging markets. And even some sort of slightly boring retailers in the US like Target have looked interesting to us. We've been adding to positions and things like that. In the regional markets, we've been finding some sellers of the Epley Property Fund in Barbados. And so we've been chipping away at that as well. But mostly relatively quiet in the funds as we head into quarter end. And for our funds is also the year end of September 30. The last thing I'd point out this week is lots of talk about interest rates. Interest rates matter in the front end of the yield curve, where the Fed changes their very short-term interest rates, but also bonds with longer maturities matter just as much, if not more, to investors, because that's where we invest. And the yields on longer-term, high-quality bonds are still quite good. And even with lower rates, we think still offer investors good protection of principal and pretty good return potential in the years to come. So that is it from here.